Imagine a person who has completely maxed out every credit card they own. Instead of cutting, spending, or increasing income, they open a new account, borrow more money, and then use that borrowed money to pay off the old balances. On the surface, the statements look cleaner. The minimum payments are met. The illusion of control remains intact. But beneath that surface, the debt has not disappeared. It has only been rearranged, extended, and made more dangerous. For any household, this kind of circular borrowing would be financial suicide. Yet this is the very logic that underpins how the United States government finances itself today. At first glance, the system appears almost absurd. The federal government runs persistent deficits, spending far more than it collects in taxes. To cover the gap, it borrows money by issuing government bonds. Then, through its own central bank, it turns around and buys a large portion of that debt itself. On paper, it looks like the government is paying itself with money it does not truly possess. To ordinary people, this sounds like madness disguised as policy. But this is not a fringe theory or a hidden conspiracy. It is the foundation of the modern global financial system. The United States has transformed borrowing into an art form, one so sophisticated that it convinces the world to accept promises instead of payment. The brilliance of the system is not that it eliminates debt, but that it postpones consequences. By recycling obligations through bonds and central bank purchases, the government sustains the appearance of stability while pushing real costs into the future. This is why the question is not whether the strategy is clever. It undeniably is. The real question is how long such an illusion can endure. Every financial system ultimately depends on confidence. As long as investors believe that United States debt is safe, the cycle continues smoothly. But when confidence weakens, even the most elegant financial architecture begins to crack. To understand why this system exists and why it matters to your life, it is essential to start with the simplest building block of government finance, the bond. At its core, a government bond is nothing more than a formal promise. When the United States Treasury issues a bond, it is effectively handing the buyer an IOU. The message is simple: lend the government money today, and in return, the government will repay that money at a future date, along with interest. Unlike household debt or corporate borrowing, these promises are backed by what is often described as the full faith and credit of the United States. That phrase carries enormous weight because it implies that the government will do whatever is necessary to honor its obligations. For generations, government bonds have been treated as the safest investment available. Pension funds rely on them to protect retirees. Banks use them as collateral. Insurance companies depend on them to match long-term liabilities. Even foreign governments hold United States treasuries as reserves, trusting that these instruments will retain value in times of crisis. This reputation for safety did not emerge by accident. It was built over centuries through consistent repayment and an expanding economy capable of supporting growing debt. However, the perceived safety of bonds often masks a deeper reality. Bonds do not eliminate financial strain. They merely redistribute it over time. When the government issues debt, instead of raising taxes, it is choosing to shift today's costs into the future. The interest on that debt must still be paid, either through higher taxes later, reduced spending, or the creation of more money. Bonds allow governments to avoid immediate political backlash, but they do not make spending free. This mechanism has enabled the United States to run deficits year after year with remarkable confidence. Lawmakers can authorize wars, social programs, and bailouts without directly asking citizens to shoulder the cost up front. As long as there are willing buyers for government debt, the system continues to function. The bond market becomes the silent partner in every policy decision, absorbing the financial consequences that voters never see directly. Understanding bonds is crucial because they are the gateway to understanding how borrowing became permanent. Once a nation grows accustomed to financing itself through debt, reversing course becomes politically and economically painful. That dynamic began early in American history, long before the modern financial system took shape. The origins of the United States' reliance on debt stretch back to the nation's founding. After the Revolutionary War, the young republic faced an overwhelming mountain of unpaid obligations. Soldiers who had fought for independence waited for compensation. Suppliers and contractors who had provided goods and services during the conflict had not been reimbursed. Meanwhile, foreign allies such as France and the Netherlands had extended loans to support the war effort, expecting repayment. The fledgling government lacked the funds to meet these obligations, and the survival of the nation depended on establishing credibility with both domestic and international lenders. Enter Alexander Hamilton, the first Secretary of the Treasury. Hamilton recognized that the government's financial reputation was paramount. He proposed a bold solution: consolidate the nation's debts and issue new bonds to honor the old ones, by proving that the United States would repay its obligations faithfully. Hamilton believed the government could build trust with investors. This approach was not merely a financial maneuver. It was a strategic assertion of national credibility. Investors, domestic and foreign, needed assurance that lending to the United States was a secure venture. Hamilton's system accomplished exactly that, allowing the government to borrow repeatedly with confidence. However, this solution also established a powerful precedent. Once the nation began financing itself through bonds, it became locked into a cycle of borrowing. Old debts were rolled over into new ones, and the issuance of bonds became a core mechanism of public finance. This cycle created a dependency on investors' willingness to lend, making the government perpetually reliant on external confidence. Bonds transformed from temporary instruments to the lifeblood of American financial stability. They enabled the government to act decisively in times of crisis, but also created long-term obligations that future generations would inherit. Hamilton's approach laid the foundation for the American bond market and demonstrated that trust and credibility could serve as powerful financial tools. Yet, the reliance on borrowing also foreshadowed a pattern that would recur throughout U.S. history: the constant balancing act between immediate political needs and the deferred costs of debt. A balancing act that would grow ever more complex with the establishment of a central bank in the next century. The early United States banking system was often chaotic and unstable. Before 1913, banks were prone to sudden failures, and financial panics could sweep across the country with devastating consequences. The government recognized that a more organized, centralized system was necessary to stabilize the economy and protect the nation from recurring crises. This led to the creation of the Federal Reserve, the U.S. central bank. In 1913, its official mandate was to act as a lender of last resort, providing liquidity to banks in times of distress and helping maintain financial stability. Yet the Federal Reserve quickly became more than just a safeguard against panics. It evolved into a partner in sustaining government debt. This transformation became most evident during times of war. When the United States entered World War II, the federal government faced unprecedented spending demands. Funding a global conflict required massive resources far beyond what taxes alone could provide. To ensure that the Treasury could borrow affordably, the Federal Reserve agreed to purchase government bonds whenever necessary, effectively guaranteeing a market for U.S. debt. In practical terms, this allowed the government to finance the war without relying entirely on immediate tax revenue. This arrangement illustrates a central feature of modern finance: the close interdependence between the government and its central bank. By committing to buy bonds, the Federal Reserve enabled the Treasury to issue more debt at lower interest rates. This partnership allowed the government to respond to extraordinary circumstances, such as wars or economic crises, without causing immediate disruption in financial markets. In effect, the Fed created a financial safety net, ensuring that borrowing would remain feasible even under extreme pressure. While this system provided stability and flexibility, it also deepened the nation's dependence on debt and monetary intervention. The government learned that it could expand spending without raising taxes dramatically. While the central bank assumed responsibility for maintaining confidence, this collaboration between the Treasury and the Federal Reserve set a precedent for the future, a model in which borrowing, debt management, and monetary policy would become inseparable aspects of national governance. It was a clever mechanism, but one that also carried long-term consequences for fiscal discipline and economic sustainability. For decades, the U.S. dollar was tied directly to gold, a system that provided tangible value and global confidence. Foreign governments holding dollars could, in theory, exchange them for gold at a fixed rate. This arrangement, known as the gold standard, was intended to ensure that the money circulating in the economy had real backing and that excessive printing could not easily occur. For much of the early 20th century, this system helped anchor the value of the dollar and reinforce trust in U.S. financial instruments. However, by the late 1960s and early 1970s, the United States faced mounting financial pressures. The cost of the Vietnam War, combined with ambitious domestic social programs, caused government debt to rise dramatically. As the Treasury issued more bonds to cover the growing deficits, doubts emerged about the country's ability to convert all those dollars into gold. Foreign holders of U.S. currency began requesting gold, testing the system and revealing its limitations. The fixed link between currency and tangible assets was becoming increasingly unsustainable. In August 1971, President Richard Nixon made a historic decision that would reshape global finance. He ended the gold standard. This move severed the direct connection between the U.S. dollar and any physical commodity. From that moment on, the dollar became a fiat currency, its value derived entirely from trust, confidence, and government decree rather than gold reserves. This transformation allowed the Treasury and the Federal Reserve to create money more freely, issuing debt without the prior constraint of gold backing. The U.S. could borrow, spend, and expand the money supply with unprecedented flexibility, while investors continued to accept bonds based on faith in the dollar's stability. Although this shift offered extraordinary freedom in monetary policy, it also introduced new risks. The system now depended entirely on perception, confidence, and ongoing demand for U.S. debt. Inflation, once restrained by gold, could now rise if too much money was created. The dollar's strength was no longer guaranteed by tangible assets, but by trust of fragile foundation that could be challenged by global economic shifts or declining faith in American fiscal responsibility. This decision marked a pivotal moment, transforming the U.S. into a financial powerhouse, while simultaneously planting the seeds of future economic vulnerability. In the modern financial system, the relationship between the U.S. Treasury and the Federal Reserve forms the core mechanism by which government spending is financed. The Treasury operates with a simple, ongoing challenge. The government consistently spends more than it collects in taxes. To cover this shortfall, it issues government bonds, formally promising to repay the borrowed funds with interest at a future date. These bonds are sold at regular auctions to a mix of buyers, including foreign governments, banks, investment funds, pension funds, and insurance companies. The appeal is straightforward. Treasuries are considered among the safest investments in the world, providing security even in turbulent times. Yet the most influential buyer is not a foreign government or an investment fund, it is the Federal Reserve, the central bank of the United States. When demand from other buyers is insufficient, or when economic policy requires intervention, the Fed steps in to purchase treasuries directly. Unlike a typical investor, the Fed does not rely on savings or tax revenues to make these purchases. Instead, it creates money digitally, adding funds to its balance sheet with the stroke of a computer key. This process injects new money into the economy, simultaneously enabling government spending and supporting broader financial stability. Through this system, the U.S. effectively borrows from itself. The Treasury raises funds to finance programs, while the Fed ensures that the borrowing costs remain manageable by acting as a guaranteed buyer. This arrangement allows the government to maintain a high level of spending without triggering immediate fiscal crises or increasing taxes dramatically. It also stabilizes the bond market, ensuring that interest rates remain relatively low and predictable, even during periods of economic stress. However, this cycle comes with hidden consequences. Every dollar the Fed creates to purchase debt dilutes the value of existing money, contributing to inflation. While the system provides short-term stability and flexibility, it ultimately relies on continuous confidence in the dollar and treasuries. Without that trust, the mechanism could falter, exposing the nation to financial instability and potential erosion of purchasing power. The concept of the U.S. government effectively borrowing from itself became most visible during financial crises. When extraordinary measures were required to stabilize the economy, one of the most prominent tools for this is known as quantitative easing. Quantitative easing, or QE, involves the Federal Reserve purchasing vast quantities of government bonds and other securities from the financial market. By doing so, the Fed injects new money directly into the economy, lowering interest rates, increasing liquidity, and encouraging borrowing and investment. This tool has been used repeatedly during severe economic downturns, with profound consequences for government finance and the broader public. The first major modern instance of large-scale QE occurred during the 2008 financial crisis, when Lehman Brothers collapsed and credit markets froze. Banks were hesitant to lend, and businesses faced severe liquidity shortages to prevent a total economic collapse. The Federal Reserve launched unprecedented programs, buying trillions of dollars in treasuries and mortgage-backed securities. This infusion of money allowed the government to finance stimulus measures, bail out failing banks, and keep the economy functioning. Without QE, the federal government would have faced a stark choice: raise taxes drastically, cut spending sharply, or allow the financial system to collapse. By leveraging its central bank, the U.S. avoided these immediate disruptions, but at a longer-term cost. A second wave occurred during the COVID-19 pandemic, with businesses shuttered and millions unemployed. The Treasury and the Fed collaborated to finance emergency programs, including direct stimulus payments to households and loans to struggling businesses. The Fed once again created money digitally to purchase debt, effectively financing government spending out of thin air. While these measures provided critical relief, they also increased the national debt and amplified inflationary pressures. The recurring use of QE highlights a fundamental reality of modern U.S. finance. The nation's economic stability increasingly depends on the central bank's willingness and ability to create money, a reliance that carries both power and vulnerability. While the mechanisms of borrowing and central bank money creation may seem abstract, they produce tangible winners and losers in society. Politicians and policymakers are the most obvious beneficiaries. By relying on Treasury debt purchases by the Federal Reserve, they can fund large-scale programs, military campaigns, or emergency stimulus packages without having to confront voters with immediate tax increases. This allows elected officials to pursue ambitious agendas while postponing the political consequences of rising government obligations. Banks, investment firms, and other large financial institutions also benefit. When the Federal Reserve buys bonds, it injects liquidity into the financial system, supporting asset prices and easing credit conditions. Stocks, real estate, and other investments often rise as a result, enriching those who hold significant portfolios. Foreign governments and institutional investors that continue to purchase treasuries enjoy security and predictable returns, reinforcing the perception of U.S. debt as the world's safest investment. However, the hidden costs of this system are largely borne by ordinary citizens. The creation of new money to finance debt gradually reduces the purchasing power of existing dollars. This invisible erosion manifests as inflation. Everyday goods and services become more expensive, wages fail to keep pace, and savings lose value over time. In effect, every dollar held by the public becomes slightly less valuable. Whenever the government relies on money creation to fund its obligations, economists often describe this as a hidden tax-quiet transfer of wealth, from ordinary individuals to the holders of assets that rise in value with inflation. The cycle also fosters dependency and fragility. With government deficits growing year after year, the United States increasingly relies on the Federal Reserve to maintain confidence and manage debt levels. Should confidence falter or inflation spiral out of control, the consequences would fall hardest on those with limited means. While elites and institutions that control significant assets are insulated, understanding this dynamic is crucial for anyone seeking to grasp how modern government finance not only distributes wealth, but shapes economic vulnerability across society. The unique strength of the United States financial system is rooted in the global trust placed in the dollar and U.S. debt. Unlike most countries, the U.S. issues bonds and runs persistent deficits without facing immediate financial collapse, because the dollar serves as the world's primary reserve currency. Oil, commodities, and international trade are predominantly priced in dollars, and central banks across the globe hold U.S. treasuries as their safest reserves. This global acceptance creates a self-reinforcing cycle. The United States issues debt. The world purchases it, and confidence in the dollar remains strong. This trust allows America to maintain extraordinarily high levels of borrowing while keeping interest rates relatively low. However, cracks are beginning to appear in this system. Some countries are exploring alternatives to dollar dominance, seeking to reduce reliance on the United States for global trade and reserves. The BRICS, nations Brazil, Russia, India, China, and South Africa, have increasingly discussed mechanisms to trade in their own currencies or commodities outside the dollar system. Meanwhile, central banks around the world have been accumulating gold as a hedge against potential instability in fiat currency. These developments signal a gradual, deliberate move toward de-dollarization, which could challenge the foundation that has allowed U.S. debt to remain so widely accepted. Should global confidence in the dollar or treasuries decline, the consequences for the United States would be profound. The government would face greater difficulty financing its spending without relying more heavily on domestic money creation. This could accelerate inflation, erode purchasing power, and strain the financial system. In addition, the perception of U.S. economic supremacy, carefully built over decades, could weaken. History offers cautionary tales. Once dominant currencies and empires have fallen when trust waned, from the British pound after World War II to France's fiscal collapse in the 1700s. Understanding the role of global trust and the reserve currency highlights that U.S. financial power is not absolute, it is contingent. The continued ability to borrow, spend, and create money without immediate consequence depends on international perception. The day confidence falters, the intricate balance of borrowing, money creation, and global trust could unravel, exposing the inherent vulnerabilities hidden behind decades of financial sophistication. History demonstrates that no empire or nation can sustain limitless borrowing without consequences. Empires of the past, from Britain to France, relied on debt to finance wars, territorial expansion, and domestic programs. Britain, for centuries, funded its navy and colonies through bonds, enjoying the confidence of global investors. Yet after World War II, the pound lost its global dominance, and the debt burden became unbearable, forcing painful adjustments and eroding international trust. Similarly, France, in the 1700s, issued massive debt to fund wars and extravagant spending, only to see the system collapse, sparking revolution and financial chaos. These examples highlight a consistent pattern. Debt can empower nations temporarily, but it is ultimately constrained by trust, confidence, and the limits of economic reality. The United States, borrowing endlessly and leveraging its central bank to finance spending, mirrors this historical pattern. For decades, Americans have enjoyed a system in which wars, economic crises, and large-scale social programs can be funded without immediate fiscal sacrifice. But the reliance on perpetual borrowing and money creation has increased systemic fragility. Should foreign governments lose faith in treasuries, or should confidence in the dollar erode, the U.S. would face a severe financial reckoning. Inflation could accelerate, interest rates could spike, and ordinary citizens would bear the brunt through higher prices, diminished savings, and declining purchasing power. The ultimate lesson is that financial stability is inseparable from understanding the invisible mechanisms that sustain it, recognizing that government debt is not free, that inflation is a hidden tax, and that confidence is the fragile linchpin of economic order is crucial. Individuals must prepare, understanding how these macroeconomic forces impact savings, wages, pensions, and mortgages. The bond trick may sustain an empire, but history reminds us that illusions, no matter how sophisticated, eventually end. The question is not if the system will falter, but when. Awareness, vigilance, and financial education are the best defenses, ensuring that when the inevitable cracks appear, individuals are not left vulnerable to the consequences that governments and markets have long postponed.